What's going on, guys? Welcome back to the channel. Welcome back to another video. If you are hanging out with me for the first time, please consider subscribing to the channel and go ahead and drop a quick like. I would really appreciate that. So guys, big changes coming from the Fed and a surprising prediction coming out of Bank of America. Now, we're going to talk about this Bank of America prediction in just a little bit. But before we dive into that, we have to touch on the elephant in the room. The elephant in the room has been the real estate market. Now, I don't know how many of you guys are looking to purchase real estate, looking to sell real estate. Maybe you're a real estate investor. Whatever the case is, you can't ignore the elephant in the room. And the simple fact of the matter is that this unstoppable real estate market has slowed down dramatically to a point where an unusual number of real estate agents are exiting the market. And this became really apparent to me when we went to book a trip and we were looking at the number of vacancies available on sites like Airbnb and VRBO for short-term vacation rentals. And this was in, several different very popular areas within the state of Florida. And to see certain areas in Florida with a tremendous amount of vacancies on Airbnb and VRBO compared to normal years, like whenever we would go on like maybe spring break or summer vacation, like we would struggle if you waited too long to be able to book a room. And this year it was completely different. And Home Depot is feeling quite a bit of pain. In fact, Home Depot's numbers reported were some of the worst numbers that have been reported in the last nearly 2 decades. And this is really surprising because Home Depot was between Home Depot and Lowe's. And unfortunately, due to Home Depot's earnings release, Lowe's received a little bit of that backlash because they're kind of in the same. They are in the same sector. So if the markets are negatively affecting Home Depot, then certainly the markets are going to have some kind of effect on Lowe's. So we'll have to wait and see what Lowe's numbers look like when they come out. But here's the thing, though. Home buyers or homeowners and investors, I think we're now at the point where they're not looking to put money into these properties. And so, of course, places like Home Depot and Lowe's are going to be affected by this. When you go from beyond the bread and butter repairs and you're going into discretionary upgrades and things like that within the home, within real estate, within these different properties, within the housing market, obviously Home Depot and Lowe's would benefit from that. But right now, the Federal Reserve has been on the tear, raising interest rates, making the cost of borrowing drastically more expensive. And so, of course, Americans are going to have to really think about some of these purchases and say, hey, maybe we don't need to upgrade our bathroom right now. Maybe we don't need to remodel our kitchen right now. Credit card interest rates are at record highs, well over 20%. So, yes, what the Fed is doing is having a significant impact on the economy. And it is also creating quite a bit of volatility in the stock market. You see, probably about half of the investors right now are thinking that the Fed is going to be pivoting and cutting interest rates because we've seen the Federal Reserve raise interest rates a good 10, 11, maybe 12 times since March of 2022. So now the question is the Fed going to pivot? The Fed started out the gate very strong with their quantitative tightening after many months of quantitative easing going into the pandemic. All that free money, all that economic boost that was injected into the economy has clearly ceased to exist. And you can feel it. Like the market has a rhythm to it. And that rhythm has drastically changed. I mean, especially when I talk to real estate agents, it's concerning for them. Many agents, especially the newer agents, many agents are saying, hey, I don't know if it's worth to continue doing this. And that's really unfortunate. Now, Bank of America has released a drastically different position than I would have expected from them on the future. So Bank of America predicts S&P 500 will test all-time highs this year, but other experts are much more cautious. So why is Bank of America predicting that the S&P 500 is going to be testing all-time highs this year, in spite of the fact that we're seeing large companies like Home Depot, who are on the S&P 500, reporting some of the worst results in the last 20 years? You got to ask yourself these questions, and these are legitimate concerns. Bank of America raised its year-end target price for the S&P 500 by 8% this weekend, citing the recent optimism backing a months-long stretch of gains, though there are a variety of factors emerging. And I think that some of those factors that are emerging that Bank of America may be referring to are some of the earnings reports that have come out. Like I said, you can't ignore Home Depot. Something strange is happening over at Home Depot. Period and point blank. Something is happening at Home Depot, and it's not just affecting Home Depot. It's affecting. In fact, I'm also predicting, and I don't know if any of the Walmarts are actually showing this already, but there was a time when you used to go into like a Walmart and you would see like a whole massive section full of electronics, but a whole back wall full of TVs, mostly smart TVs. And now I cannot say when was the last time that I saw someone purchasing a smart TV. Like and I'm not the nosiest person, but I pay attention to my surroundings. Whenever I'm checking out, I happen to look around. I'm not blind. I'm fairly aware. I just don't see people loading up their carts anymore with smart TVs. Now, this could be just purely anecdotal, but I just feel like the consumer is really, really feeling it, and they're really being tapped out. Period. And right now, consumers are literally making purchases only covering necessities. They're attempting to manage these higher than ever credit card bills and ultimately higher than ever credit card interest rates. Now, we've already reported that credit card debt is now approaching $1 trillion, which is a level of debt that has never been reached before. Now, at some point in time, these debts are likely to be, let's just say, American consumers are getting tapped out. Some of these debts will not be paid, period. It's just not going to, this can't continue, especially when you look at the number of layoffs that are happening. And if you are putting your if you're putting your necessities on credit cards, that means, and you're not paying that bill off at the end of the month, that means at some point in time, those necessities, the thing is if you have necessities every single week that need to be purchased, and if you're not able to pay that bill off in full at the end of the month, at some point in time, you're going to reach the limit. And once you reach that limit, you can't put any more expense onto those credit cards. But those expenses still need to be purchased. So what happens at that point? Well, we need to put another expense on this card, but we've already maxed out the credit card. Well, we still need the expenses. So you know what? We're going to take this money that we would have used to make the minimum payment on this credit card, and we're going to go ahead and buy our groceries for the week. Well, that grocery money that would have paid for that credit card bill is now gone. And this is likely to be the start. That's just, my basic thought process on what might happen here. But at the same time, I am still preparing, and I'm looking at different opportunities in the stock market. ETFs, index funds. Bank of America's got a bullish forecast, and it came amid a flurry of far more cautious predictions from Wall Street, which is led by Morgan Stanley's ever bearish head U.S. strategist Michael Wilson. So basically, Morgan Stanley is disagreeing with where Bank of America is coming from on this one. Morgan Stanley's ever bearish U.S. strategist Michael Wilson, who wrote Sunday that the S&P 500's nearly 15% gain over the last 6 months is a little bit more than a head fake rally fueled by mass panic buying. So basically they're saying, hey, don't believe the hype. This market is about to turn around, perhaps. That's how I'm taking it. Optimism fueled by AI advancements, a less aggressive Federal Reserve, and a lack of fresh geopolitical disturbances won't predict the deep earnings recession on deck for later this year, as higher demand as higher interest rates continue to eat at economic growth. We're already seeing this with Home Depot. Home Depot and their earnings release is just a precursor to what could possibly be coming down the pipeline. So drop me some comments down below, guys. Let me know where you guys think the stock market is headed going into the end of 2023. Are we going to be seeing this recession? Are we going to see this massive pullback? What do you think that the Fed is going to do during their next meeting? And I believe that the Federal Reserve's next meeting should be June, if I'm not mistaken. Is the Fed going to raise interest rates? Is the Fed going to be dropping interest rates? Is the Fed going to pivot? Or does the Fed just say, hey, we're not going to do anything during this session. We're just going to keep the rates as is. Drop me some comments down below. I'd love to hear from you guys. Also, if you guys are new to the channel, please consider subscribing to the channel and drop a like for this video. Totally appreciate that. Share this video with a friend, and I'll see you guys on the next one. Bye.